Morgan Stanley released their earnings result today, and how will the stock respond? Rising interest rates are generally a positive environment for financial stocks, as higher interest rates usually means higher profit margins for bank loans charges. Now, this earnings season's, there is a focus on banks' net interest income reports. This is the difference between what the bank's revenue from interest-bearing assets are and the cost of servicing these assets. Investors are wanting to make sure that debt default expectations don't rise rapidly to assess how healthy banks' earnings really are. So, what are the seasonals like for Morgan Stanley? Well, they're quite mixed. At first glance, from the 17th of Jan through to say the 5th of February over these earnings seasons, you can see that the average return is pretty good at 5.21%, but you can obviously see there's one outlier event here in 2009 at the end of the global financial crisis, as bank stock once again became attractive at bargain levels. Now, if you just use the filter that SeasonX helpfully provides here and take out that 2009 data, you quickly see actually the average return is a far less impressive 1.28% and a much more mixed spread of gains and losses over this earnings period. So does this mean Morgan Stanley is worth passing over this earnings seasons? It could do. Or will the actual results reveal some hidden value, perhaps some really good net interest income aspects to the report that get investors excited? Major trade risks. The major risk here, of course, is that Morgan Stanley do surprise with some good results that causes investors to buy into the stock. Otherwise, the seasonals are not so hot for it. Remember, don't just trade it, but season exit.